I think investors look at the amount of capital that has been flowing in to private companies through private credit funds and ask the question of whether private credit's a bubble or is there too much capital chasing too few deals in private credit? And I would say no. Firstly, one has to get their mind around a few concepts. The first is before the great financial crisis, you go back to, call it 2006, 2007, the US economy was about 12 trillion or so in size. Today, US GDP is in excess of 29 trillion. The size of the US economy has grown by roughly 2.5x since before the great financial crisis to today. And so that's the size, the tremendous size of that economic activity that we're lending into. The banks have been the traditional providers of capital into the private credit markets. And if, again, you go back historically, you go back to the 1980s, there were roughly 15,000 banks in the United States. Today, there's roughly 4,000 banks. Regional banks and middle market banks that were providing capital have shrunk dramatically. They have been consolidated into these large mega banks. And these large mega banks simply don't focus on lending capital to middle market companies. They have retreated. And that has happened on the back of significant regulations that have impacted them through the great financial crisis, Dodd-Frank, Basel III, that has caused them to increase their capital reserve requirements and resulted in them backing off providing capital to these middle market companies. So these are the companies demanding this capital. They simply, years ago, did not know where else to go for capital than the banking system. And today, they just have far more greater sources of places to source this capital from. They can go to private capital and direct lenders to provide them with this capital to help grow their businesses. So I think these concepts are all really, really important because it speaks to the qualitative aspects and some of the economic data aspects that drive private capital demand. So if you think about it as private sector credit as a percentage of our country's GDP has been completely stable over the last 11, 12 years in this post-great financial crisis period, roughly ranging from 21 to 25% of GDP. Today, it's about 23%, so really right smack in that range. And that, quite frankly, is very different from what we've seen from real private credit and credit bubbles that have transpired over the last century or so. The final point I would make is on the future capacity for demand for private credit. And here, I would look to the amount of private equity capital that is categorized as dry powder. So that is capital that's been raised into private equity funds, which still needs to be deployed over the next 3 to 5 years while those funds are still in their investment periods. And so that capital has a shot clock. The total amount of private equity dry powder globally is $2.5 trillion. It's $1.5 trillion just here in the United States alone. Typically, $1 of private credit needs to be married up with each dollar of private equity deployed. So think about that. That would require a demand of upwards of $2.5 trillion of private credit to be deployed against that $2.5 trillion of dry powder in global private equity. Today, direct lending and private credit funds have $500 billion of dry powder. So when you think about $500 billion against a market opportunity of as much as $2.5 trillion, that would imply there's still significant room for opportunity and growth in private credit today.